Yeah, as you mentioned, John Banister with Bisnow, cover commercial real estate. So I've been covering the office market for many years, and I'm excited to get into it on this panel. I'm going to start with some self-introductions. Julie, you want to kick us off?
Sure. So hi everybody, Julie Whelan from CBRE, Global Head of Occupier Thought Leadership. So from an office perspective, which is what we're focused on today, that research team sits under my remit along with some other things that I do, including data centers. So happy to be here and talk about this today with all of you.
Hey everyone, Danny Mangru. I'm here with Avison Young. I am the U.S. Office lead within our market intelligence platform. I oversee all of U.S. office efforts across the U.S. And pretty much every single office research reports into my organization. So happy to be here.
Thanks, Sean. Thanks for having me here. My name is Greg Fuller. I'm with Granite Properties. We're based in Dallas, Texas. We own, manage, lease office buildings throughout the country, from California to Atlanta to Boston, Nashville, Colorado, and Texas. And happy to be here.
Great, thank you. So it's an interesting time in the office market right now. You know, we're more than 5 years since the start of the pandemic. There have been a lot of changes in the way people work and the demand for office space. And you know, it's really broken down into a few different stories depending on the segment of the office market. So I'm gonna structure our panel that way. You know, we're gonna start by talking about the top tier, you know, the trophy prime offices, so to speak, and what's going on with that market. And then we'll move down to talk about some of the lower tier office buildings later and what's going on with them. So I want to start with Julie on the trophy segment. You know, we've heard a lot about this flight to quality. Obviously, that's a big term used, and you know, tenants have been leaving older buildings, going toward you know, newer, high quality space with all the amenities in a great location. So from an occupier perspective, what do you see driving that trend right now?
Yes, yeah, so it's a really good question. So I think that there are three main things that are driving what we would call this flight to quality right now. First and foremost, and probably the most important, is the fact that office remains central to corporate culture. And we hear a lot of both sides of this story, right? Those that think that remote is here to stay, and those that think that everybody should get back to the office. And we squarely believe, from all the research that we do and all the discussion with clients that we have, that it is somewhere in the middle. And most organizations want their employees in 3 days a week, and in order to do that, they have to, what we call, quote unquote, earn their commute, which means that they have to put them in a building that is absolutely, first and foremost, convenient and accessible. So a lot of what we see from a quality standpoint has to do with location. We also need to make sure that they are in a building that has a great tenant experience once they're actually in the building. But then location of where that building matters also, where that building is matters also, because does the neighborhood that that building is in actually suit my employee's lifestyle outside of work? And so that's a main driver of kind of this flight to quality, is having all three of those things come together. Do I have a convenient and accessible place for my employees? Is it a good tenant experience? And is it a good lifestyle match from a neighborhood perspective? Secondly, what's driving it is it's not all about the employees, right? And so operational efficiency is really big for a lot of organizations right now. And although we talk a lot about employee experience, we also have to keep in mind that cost is a major driver and inhibitor of real estate. And so when you come to these better quality buildings, it makes sense for some of the larger organizations especially to go into them, because they tend to have that operational efficiency. They're energy efficient, they have good floor plates, they have building services and amenities that the tenant themselves can draw on, so they don't have to be building all these spaces within their own lease space. So there's a lot around operational efficiency that's driving this flight to quality. And then lastly, what I would say is it's not really people in organizations that are in much lower commodity quality buildings that are making this leap up to prime buildings. What you see is it's a lot of organizations that are in that kind of like class A space today, in an aging building that maybe hasn't been renovated in a while, and they're the ones making that leap up to the prime, because those that are in that commodity space, that BC space, tend to want to stay there because they are cost conscious and they're generally happy with where they are, even if it doesn't have all the experiences that they're looking for. So that's kind of what we see is driving these trends, and we just completed our occupier sentiment survey for 2025. It'll be coming out in just under a month. And I would say that what we're seeing is supporting a continued trend in this direction. We have now for 3 years been seeing that our clients are planning to expand their portfolios more than ever, and we now for a third year in a row are seeing that sentiment with 43% saying, yep, I'm gonna be bigger in 3 years than I am today. That is markedly different than where we were just a few short years ago. And then also almost half are saying, and we're really concerned that the availability of the quality and location of space that I want is gonna be there when I'm going to look for it. So although that doesn't feel in line with this major, headline vacancy rate that we're seeing, because there's so much of the office market that's discounted today, these are the feelings that are, happening with our clients today.
It's interesting. I'm looking forward to seeing the sentiment survey. I want to go to Danny and talk about how that is shaping the dynamics of that trophy office market. What are you seeing in terms of availability tightening, in terms of rents and the leasing market for that space?
Yeah, sure. Just wanted to add something to Julie's point too. There's a stat that I always throw out here that really speaks to the flight to quality. Across, I would say, majority of gateway markets, at least 70% of demand has been within A in trophy. And that's across Atlanta, Manhattan, Dallas, Houston, Boston, Chicago. The only gateway market that does not hold true is DC for obvious reasons, we're on the government sector, but just a staggering stat. And this has been, I would say, since 2018, that has been the case. What I like to do now is just kind of peel it back here a little bit. We can talk about trophy and then talk a little bit about Class A. So the trophy sector, and I'll start with supply real quick. We've seen, I would say, across many markets, just a drop in trophy supply year over year. Some interesting markets too, like Charleston, for example. 9% drop in the availability rate at the trophy sector for Charleston. Now, I know it's a small market, it's about 12 million square feet. The trophy's probably roughly about 900,000 square feet of inventory, but it's still phenomenal just to see that drop. Same thing in Raleigh, same thing in Atlanta, Manhattan. Manhattan, where I sit, it's actually dropped roughly about 4%. Atlanta's about 3%. So you're seeing a lot of the markets drop within the trophy sector. Now for Class A, you're seeing Manhattan drop, Atlanta drop, Tampa drop as well too. So you're seeing really a bifurcated market across, I would say, majority of the gateway markets at this point, outside of a few.
And I can just build on that a little bit. So, if you know real estate, you know that Class A, B, and C is typically how we track real estate. But Class A is like 60% of the market, so it's really hard to tell a story on Class A. And so what we did is create a prime set of data of about 800 buildings across the US so that we could actually start to look at what are the trends telling us. So at a headline vacancy level today, we're at about a 19.2% vacancy rate nationally. Now some markets like San Francisco are up at 36%, and other markets like Manhattan are actually not that bad. They're still in the mid double digits. And so what we're seeing though is that when you look at that prime set of space, that vacancy level is down under 15% today. And there are certain markets, like if you take even San Francisco, in San Francisco CBD for their trophy Class A building, they have under a 13% vacancy rate right now, whereas the rest of that CBD is at a 33% vacancy rate. Same thing with New York. When you look at the New York better buildings, they're at about a sub 12% vacancy rate. And then you look at even the micro market of Park Avenue, and that's at a sub 8% vacancy rate. So with this lack of new construction that's coming, because construction is a difficult thing to swallow right now, new construction, and so we see the numbers dropping off a cliff. It's like 15 million square feet are gonna be delivered this year. That's under 30% of what was delivered back in 2019, and it's only gonna get smaller every year from here. So if you think about that, along with this insatiable demand that's going into this very small cohort of segment of the trophy product, it begins to make you realize that we're gonna run into a challenge. And our best estimate is that by 2027, we're effectively gonna be out of prime trophy space in the market, which leads us to say, well, what's next?
Right, and so that's sort of shifting the market toward the landlord's favor then, right? If you're a large tenant, there aren't very many options for you for that prime sector of space, right?
Yep, there are absolutely anecdotal stories of multiple tenants touring the same spaces, and for that segment of space, it's more in the landlord's pocket, for sure.
Just to add to that real quick, you know, just talking about concession packages, and this is a perfect indicator, right? You know, across the board, we're looking somewhere between 5 to 10% decrease in concession packages at Trophy and at A-plus products. So I think that's really an indicative sign right there of where the market's heading.
And, you know, I want to talk about a specific example of a Trophy office project that was just built in Dallas. Greg, you know, as we talk about the lack of supply coming, you just showed an example of a successful Trophy office project. You built it and you got big leases with Sidley Austin, Deloitte, Banco ZK. What was driving those tenants to lease your building? You know, where were they coming from, and what specifically drew them to that new product?
Well, I think you could ask Julie all these questions, and whatever she says, I'm gonna agree with, because she's got all the facts and figures around this. And all I really heard was, if you remember back in the day when you had the RTC in the late 80s and early 90s, for those of you old enough, Trammell Crow coined the saying, stay alive till 95. What I heard you just say is there ain't no heaven till 27 for the landlord, so I'm gonna bank on that.
It's a new one. Wow.
Yeah. And there's a reason for that, and I can get into that a little bit later. The product that you mentioned, we did start a speculative office building at 600,000 square feet in uptown Dallas. And as Julie was pointing out, the sub-market really matters. The micro locations are really mattering in this cycle. And we were fortunate enough to have a site that we already owned product on, that we actually tore down 3 buildings and built a much larger, it was only 100,000 square feet of buildings there. We built 600,000 square feet of Class A product. And fortunately, we built that, or started that project, and made that decision right before the interest rates went up in March of 22, I think it was. And our construction cost was probably 30% below what it would be today. So that's an advantage. And so the rates that we're receiving because of this flight to quality, you asked which tenants are coming in. You mentioned the 3 that are, they're moving around from the market. So what Julie said is exactly right. These are high quality tenants that either couldn't accommodate their expansion in the existing building, like Sidley, they're moving to 125,000 feet from 85,000 feet. Banco ZK was being pushed out by Texas Capital Bank in a different space, and so they needed new space. So they wanted the best of the best, and the reason they do this because the types of people they're hiring, they need to attract that quality worker. And so those are the types of customers, fortunately, that this type of building attracts. And I think you'll continue to see that in this go-around. At the unfortunate, the rest of the buildings and a lot of buildings in the market are not going to see that. And it doesn't matter how many amenities you put in it, if it's not in the right location, doesn't have the amenity base inherent to that, they're going to struggle. And they're going to get reset. Somebody will come in and buy them at a cheaper rate, and they will provide a cheaper alternative to the best of the best.
Yeah, I'm going to come back to that to talk about some of those older buildings, but I want to stick with development for a little bit because Julie mentioned, by 2027 we're going to have very little vacancy in that trophy space. And Greg, you just completed this building, and you don't have any other office under construction now, you said. So, given that tightening market, I mean, when do you think you might be able to build another office building again? Are you looking at projects right now to try to do that?
Yeah, we have land and we're planning them. We are looking at lots of different projects in the various cities. And I think that 27 makes sense to start something probably in the right spots. But think about it mathematically for a second. This all occurred in 2020 with COVID, right? So the average lease in an office building, especially a speculative type multi-tenant building, is 7 years. So that takes you to 27, right? The people who were making decisions on their space in 20, 21, 22, they were just reacting. They didn't know exactly what to do because they didn't know what the future held. Then you have the next group of people from 22 to 25, and they're making decisions, but they're more informed decisions. So they are going to the better space to get their folks back to work. People had, this whole trend started in the mid 2010s, call it 2014, 15. That's when the amenity race started. That's when, if you look at CoStar statistics, that's when flexibility and working from home started. And then it just, went on fire after COVID. And so it just accelerated a trend that was already starting. So if you look at that, and people are making decisions, most of the tenancy will have made a decision by 27. So supply and demand is going to dictate, because nobody can build anything because of what it costs today, and what the interest rates are, and the value decline that we've had in other products. So it will start to make sense for the best of the best to start to build a speculative building in 27 and deliver in 29. And and some of it's just math, supply and demand is going to tell you that makes sense.
Yeah, and I would agree. I mean, there are absolutely pockets of the nation where more supply is needed today. Personally, I would love to see a world where instead of building new, we are repositioning what is already existing. Because I think that over the last 50 years, there has been obviously all of the space that we are living in right now has been built, right? And to a point, I would argue that maybe we're at peak office, where we actually don't really need any more office. We just need it to look different than it does today. But that repositioning discussion is a really hard one to have today for all the reasons that Greg mentioned, right? Construction costs have escalated, the uncertainty around tariffs, the interest rates that are high. And so I actually heard a colleague the other day say that a stabilized asset is the new value add strategy right now. And when you look at our office market, and this might be a surprising stat, but 75% of the buildings nationally are over 80% occupied, which means that they're generally stabilized, right? And so if you have investors that are coming in and prioritizing that right now, and maybe needing to make a little bit of tweaks to keep tenants happy to keep them in, but really that value add strategy is somebody coming in and repositioning a building, it's just not lucrative for anybody anymore. And so we're really in this kind of bottleneck of a position that is going to be great for some landlords over the next couple of years, but then increasingly difficult for tenants that want to operate in this space. So it'll be interesting to watch.
Mm-hmm. Danny, do you have anything to add on that development landscape as you look out, what we might see in terms of new office starts?
Yeah, I totally agree with Julie's point there about the repositioning. So, and I'll take Manhattan where I sit, that there's really no land left for new development, right? And so there's a lot of these urban markets where there's gonna have to be some repositioning to be happening. But, the challenging aspect right now, both what Greg and Julie said, there's also financing issues too, right? Right now, getting debt right now is extremely bifurcated. So it's only a relatively few healthy markets that's actually getting access to finance, and the rest are just pretty much on a trickle right now. And so I think that's going to be some challenges as we head into the next, call it 3 to 4 years, particularly with developments.
Yeah, and as you move down to some of these lower tier buildings that need to be repositioned, we have seen some examples of that, but it seems like there are challenges because the prior owner bought it at a much higher basis than it's now worth, and the projects where that happens, tend to have some sort of ownership change, whether through a foreclosure, bank taking it back, or or just a short sale type of deal. I mean, do you think we're going to see more of that coming up, more buildings going through some sort of financial distress, and that could potentially lead to repositioning if a new owner comes in at a lower cost?
Yes.
You think? Are you looking at those types of deals?
We are. I mean, we are an investor, so we're looking at acquiring, we're looking at developing all the time, and we are under contract on a building right now that is just what you're saying. It's still in a great location. The ownership didn't have to have great sponsorship, so they're going to lose the building. So we're going to come in and buy it, and it is still in a great location. By the way, trophy and Class A, if it's a Class A location, the age and the quality of the building is less important. So one of our best buildings is in Cherry Creek, Denver, which is one of the best markets in the country. Our asset is a 1980s vintage, we have 2 assets there, and they have the best effective rates of anything in our portfolio.
Mhm.
So location, 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 which was the first thing I learned in the 80s when I got in this business, is still more relevant than it's ever been. So I do think you're gonna see a reset. You're gonna see lots of buildings go back, not necessarily the lenders, but the sellers are just gonna have to acquiesce. Or it will go back to a bank and then the bank will clear it. And so those types of assets will get reset and they will be a low-cost alternative for lots of customers that can't afford. I mean, we're talking in Dallas, Texas, $100 all-in rate. I mean, that's a lot for a tenant to pay, unless you're a big company that, you know, I think you said economies of scale relative to the real estate costs. You know, it takes a big company to do that. So not everybody can do that. So you're gonna have a reset and you're gonna have this continued bifurcation of quality of product and location of product and what those customers can do.
Mhm.
And I do wanna emphasize that point that Greg just made, because don't underestimate I would much rather have a non-prime building in a wonderful location than a prime building in a challenging location any day. Because I do think that location is a rising tide for all spaces, short of having an absolutely dilapidated space. But, you know, it's really location matters an incredible amount.
And when you're talking about location, it's the amenities around. I also, sorry, I find that it's the commute as well, right? People are concerned about commute post-COVID, maybe more so than they were before.
Yep, the commute is a huge piece of this, so, and it seems so simple, right? But there has been a shift in mentality around what I started out by saying, which is it convenient and is it accessible? And that's gonna mean different things. If you're in an urban gateway city that has really great public transportation, right? That most people are getting on to come into work, or if you're a suburban location that needs good highway access. The name of the game is having a convenient and accessible spot, because you cannot guarantee the same time commute for everybody in your company, because there's gonna be turnover and people are gonna move and you can't solve for that. But what you can solve for is at least what is in my controlled, which means that am I on a train line? Am I on a bus line? If I'm not, do I have great shuttle service? Do I have great car parking? Do I have EV charging? All of these things that matter to the employee experience and making it convenient and accessible is the #1 thing. We, in the survey that we just did, asked about amenities and what are most important to you, and we asked our survey takers to say, would you completely remove a building from your short list if it didn't have these things? Would it impact your rent negotiations, or would it not impact at all? And the only 2 things that they would completely walk away from a building for if they didn't have it had to do with this convenience and accessibility, being public transit or car parking. They are deal breakers today, which is why this location thing, especially in your gateway markets, matters, because it's when you're sitting on top of those hubs of people coming in that those are the buildings, regardless of class, that are doing really well.
Yeah, my office building is right on top of Metro Center in DC, so I definitely agree with that. Danny, you put out a report recently on the Class B segment of the office market, right, and seeing some momentum building in that space. What were your takeaways from that? What's driving that momentum from your report?
Sure. Just to quickly add just to the whole employee experience, you know, one of the studies that we've done, and just interacting with our clients as well too, if there's a short list of 5 buildings and the commute time is over an hour, it's off the list, regardless of amenities or et cetera, anything like that. Quite frankly, the commute time actually outweighs to a certain degree the actual rent premium associated with some of these buildings. So just wanted to add that there a little more of a quality data there point, but it's something that we hear all the time from our clients. Shifting to Class B, so where I sit now, looking for a broader recovery stage, it's markets where you're starting to see Class B activity increasing year over year over the last 24 months. One of the surprising markets where we're actually seeing that is in San Francisco. And it's stemming directly from the tech sector, specifically AI. And it's happening with these smaller companies. So think about these venture capital companies, these smaller, call it 2,000 to 10,000 square feet, they're relatively new, they need space. and they're gravitating towards Class B. Now in San Francisco, it's a little bit unique in the sense that their trophy, I think it's like 3% of their overall inventory is trophy. The rest of it goes into A, B, and C. So year over year, San Francisco is seeing 33% increase in Class B activity. That same phenomenon is happening in Manhattan. Manhattan's up about 22%. Now, obviously, the reliance on the banking and finance sector has a lot to do with that, but also the tech sector. The tech sector accounted for, over the last 12 months in Manhattan, a little bit over 15%. And it's that same phenomenon where you have a lot of AI companies, a lot of tech companies, particularly within the venture capital world, and they're looking for space. They're looking for cheaper space. And so those are two markets, and then Dallas as well too, we're also seeing an increase in Class B activity year over year, I think roughly about 15%. So where I sit now, these are markets that are pretty much encouraging here of a broader recovery across all asset classes. So I thought it was pretty interesting just to look at that and the actual industries that are playing a different role in it.
So I would completely agree with that. And from a BC standpoint, we often talk about flight to quality. When we're talking flight to quality, we're talking like the really well-heeled organizations that cost is honestly not even an issue over getting people back and getting back into the groove of things. There is a lot, though, of transactions that happen in our market on an annual basis that cost is a major factor. And what we see right now is that renewals are elevated over where they are historically. Now, they have come down over the last couple of years, but they're still historically at an elevated place. And it's because a lot of these BC landlords see the writing on the walls, and they're gonna do anything that they can to keep these clients and these tenants that are cost conscious and that they're probably reaching really good deals for. And I do think that that's going to continue, because in that survey that I told you about where 43% of occupiers are saying they're going to expand, well, if you cut that by occupiers that are under 500 employees, that number skyrockets to like 80% of them are saying that they're in a growth phase right now. So it is going to benefit, I agree, this lower quality space. I actually think it's the aging Class A space in some of these markets and poor locations that is going to struggle the most going forward.
I'll quickly add to that too. So, and I'm gonna take Manhattan where I sit. We're seeing that trickle down effect happen now. And so as the trophy supply is starting to shrink, you're starting to see that A+, A minus, and now it's actually trickled down to B+. When we start looking at this a little more granular, and I'll use Manhattan as a perfect example, that B+ share of leasing activity has actually increased over the last 18 months. I believe it's up about 6 to 8% roughly. So I would imagine that same trickle-down effect that we're seeing in Manhattan will sort of translate across other markets. And that's really going to set the stage here for recovery. We actually put out a recent data bite, I believe about a month ago. And what we did here was we kind of looked at the averages today versus pre-COVID, and which markets are essentially, any market that's, I would say, roughly 25% behind the pre-COVID averages, it's probably on the road to recovery. And there's a lot of markets that fall into that category. Dallas, Houston, Chicago's slightly behind there. Manhattan, believe it or not, Manhattan's actually on par with the pre-COVID average. So they're like in the top of the 8th inning right now in terms of the road to recovery. Other markets don't like Boston, and Boston's been having really challenging times, I would say, in the last 24 to 36 months. They're one of the few markets where we're actually seeing availability increase at the top of the market. Trophy in Class A has actually been increasing. I believe it's somewhere between 2 to 5% over the last 12 months. However, there is a bit of a silver lining for Boston, and I kind of wanted to bring this up because one of the things that we saw that happened in 21 and 22 is we've seen an influx of law firm activity happening. And law firms tend to be that kind of precursor for transacting at the bottom of the market. And we've seen an uptick of that happening in Boston. As a matter of fact, I think leasing activity just for law firm itself in Boston was up roughly almost 300%. So there's some silver lining there for Boston, but the road to recovery is definitely here happening, and that trickle-down effect, as I just alluded to, I suspect to start happening in other markets.
Yeah, we covered that report, and I manage Boston too, and so I do see some of that you're talking about. There's a lot of availability. What are some of the other weaker markets though? Like, are there other lagging cities that you see as needing to catch up?
Yeah, I would say Chicago is a perfect example of a strictly bifurcated market. So top of the market, the trophy is just making about 70-80% of leasing activity right now. And the bottom part, call it the B and C, is below 20% of the actual share. And I think Chicago as a whole, they do have a bit of a supply problem. And you know, it's essentially, the B and C makes up so much of the inventory that it's just lagging behind. So that's one market where I see things continuing to struggle. Boston, as I alluded to, but there's still a handful of markets that's improving. You know, I look at the central region, the Texas markets have been improving over the last 12 months. I look down south. The Florida markets kind of were in the that seventh inning in 22 and 23, kind of that COVID effect. They kind of stopped back here into kind of a seventh inning stretch, but you know, they're still improving. I look at Miami, for example, their trophy availability has been declining, so a lot of good stuff happening, but still a lot of markets still bifurcated. And I suspect that will continue to happen in the next 24 months.
Yeah, I think the only thing that I would add to that is we're seeing improvement. I mean, when you say improving, it's hard, 'cause it's like, by what metric are you asking that on, right? But over half of the markets that we track, so just under 30 markets, have improving vacancy year over year, meaning that their vacancy is decreasing. We haven't seen that in 5 years, right? So that's pretty impressive. The markets that are struggling right now are the ones, I think, that came out of the gates really quickly, right after COVID, right? The markets like Nashville and Austin that actually have a lot of new supply relatively being delivered in their markets right now, when there is a slowdown in demand for those markets. And as a result, they're still seeing some increasing vacancy, but it's not because this is a long-term effect. I think it's because they're a little bit out of whack supply and demand wise.
I want to talk about the bottom tier of the office market. Some of these buildings that are getting taken out of the inventory, basically, by being converted to other uses, being torn down. Julie, you put out a report on this recently about the amount of office space decreasing. Do you want to talk about that, or what the takeaways from that were?
Sure. So right after the pandemic, we started to say, okay, we got to focus on what's happening with conversions, because it's not an easy thing to track, right? And so we have the luxury of having researchers in every market, and so over the last couple years, we have every 6 months updated what does the conversion story look like, how many conversions are happening, and how is that transforming cities. Well, this particular update, there was something that created a major milestone moment, and that's that for the first time, certainly in the 21st century, and I would argue ever, we have more conversions and demolitions happening this year than we have new supply coming to the market. So what does that mean? Is that in essence, what I said about peak office supply is that we're starting to see a ever so slight contraction. Do I think that that's going to be super long-term? Probably not, but over the next handful of years, I think that there will be a bit of a rebalancing. And we're not talking hundreds of millions of square feet. I think it's a 10 million square feet difference, but that still is a marked change where we only have about 12 million square feet being delivered, but yet something like 25 million square feet being either converted or demolished. So what that's starting to tell you is that the markets are starting to rebalance. You're starting to create in a market where the commercial real estate in the market is being transformed into its highest and best use, which is extremely important, in order for a market to operate at its highest and best use. I don't think it's not gonna be overnight. This is gonna take a number of, I think, real estate cycles to truly get through, but it is encouraging, to say the very least, of what we're seeing.
I think that'll last as long as capital's not available. Because as soon as capital is available, developers will develop, and we'll have a supply, we'll increase the amount of supply. Because the number of buildings that are convertible from just an economic standpoint is still pretty de minimisly small, right, as a whole. We have tried to look at converting office buildings in suburbia. You cannot make the numbers work. We have looked at converting buildings in downtown Dallas. I could take the building for $0 and still not make money. So cities are gonna have to get involved, governments are gonna have to get involved in subsidizing these in order to make more of them where they're even possibly feasible, where it's got the right floor plate in the right location. It's just gonna take a lot of help in order to make them make sense.
Couldn't agree more, and I do think that that's why we're starting to track demolitions, because I do think that there are some buildings that just have to come down, because they don't have another use, and they're gonna become an albatross on their market. that if they're not kind of plucked out of them, then it's just gonna continue to be a drag on what that market feels like.
Greg, can you expand on what more do you think local governments can do to incentivize those types of conversions? Like how much subsidy or you know, what types of incentives would help that move forward?
Well, typically they'll start with tax abatement, and most of them will give, 90, 100% tax abatement for the next 10 years, because they're looking at zero tax revenue anyway. So giving a tax abatement, that starts there. Some cities are gonna have to buy these buildings and or these sites and then do a public-private partnership in order to make them make sense. Not many developers go out there with the intent to lose money. So unless they can do something to lower that cost, because even at a zero basis in an existing building, you gotta be able to cover the expenses. And so if you're gonna convert it, your expenses and your costs obviously continue to go up. And conversion from office to residential, the residential can typically pay the most for that. Conversion from office to a warehouse is much tougher. And there's only certain cities and certain locales where this really works. The older markets, Philadelphia, Boston, New York, you're gonna see more of this. San Francisco, Dallas, it's pretty hard. There's been a few, and there will be a few in every market, but they're just not that many to move the needle. That's my concern with it. And in suburbia, it's almost impossible.
What's interesting though is that downtown Dallas does come up on our list as having the most concentration. Something like 12% of office stock in downtown Dallas is under conversion right now. So there are pockets of it where it seems to be making sense. And my belief is that if you can get some of this moving in concentrated areas of the city, then it's actually a rising tide for the leftover office buildings that are there also, because now you're starting to create a mixed-use district that may become the next up-and-coming district, right? So that's all something to watch.
All right, I want to open it up to the audience. Does anyone out there have questions? Jared?
I apologize, I have many, but I'll try to keep this brief. So, Julie, you mentioned that when you go back by memory, 70% of demand for trophy among tenants, correct? I wondered if you tracked the number of tenants that are actually in that demand. Is it growing or shrinking? Meaning, the number of companies out there that are willing to pay the freight for trophy, is that a growing trend, or is that or the number of companies shrinking over time?
Yeah, so I think that might have been Danny's stat on the actual number of tenants, but I think that, so first of all, when we're talking about the cream of the crop buildings that are prime, we're not talking the majority of the market, right? We're talking 10%. So my gut would tell me that the amount of occupiers that are looking in that space is continuing to grow from a demand standpoint. I don't have direct numbers there, but the reason that I arrive at that conclusion is assuming we stay in a stable economy. You have companies that, as Greg said, are more certain than ever about what they want their future portfolio strategy to look like. They're willing to execute on that today, especially because many of them understand that the space that they want might not be here in a couple of years. And what all of our sentiment is telling us is that demand for space is growing. So I think that's going to be a rising tide across all of commercial real estate from an office perspective, but especially that prime space.
Okay, then, last question real fast. This past office cycle we just went through was kind of characterized by this migration of corporate America from the West Coast to the Northeast, which led to a lot of new deals popping up in the Southeast markets. Is that trend continuing, or do you see that stopping, slowing down, reversing? Where is that migration looking today? Corporate relocation looking today?
So, and we can actually share a report that we have done on headquarters relocations, and it does continue to be a trend. I can't tell you the exact numbers off the top of my head. One of the things I think that is lesser known about that is that sometimes when those relocations happen of the headquarters, it's not necessarily kit and caboodle with like all the employees employees that were working. A lot of the employees still remain in the location that that base of talent is in, which is either in the west or the northeast, even though the quote-unquote headquarter, is moving to maybe what is perceived to be a more business-friendly environment. Not to say that that's not starting a wheel turning, that over the next 5-10 years, you do get more employees there. But we have a report on that we can share specifics.
Who else had questions? Right here in the front.
So you had mentioned the high rate of office conversions in downtown Dallas, 12%. Is there a sense, either from Greg or Julie, why Dallas is such a leader in that, and what would a contraction look like if there's such a leader in that? Is there, what could we expect if that doesn't work out?
If what doesn't work out,
So obviously those numbers are working to be a leader, and I guess I'm just curious of why, what's unique about that Dallas downtown market that's making it work?
So I mean, you probably know a lot more than I do about this, but I do have a theory, but go ahead.
Well, you tell me your theory, I'll tell you it's right.
So my theory is that, one of the things that happens in a market like Dallas is, we've talked about Uptown, right? Uptown was able to be a market that was created, and there was a lot of demand that then went to that, but it left behind a challenge of downtown Dallas that, by the way, even before the pandemic, was dealing with very high vacancies. So I think that there's a little bit of time, right? Because if you look at one of the markets in the US that has the most conversions underway, it's Cleveland. Well, what has happened with that is that they've been dealing with that since the financial crisis. It was right after the financial crisis that they decided that they had to do something, and between public-private partnerships and building values that fell and zoning and tax incentives, they made it work. And so from a Dallas perspective, I think it's similar, right? Where it's just they've been dealing with this for a long time. They know that that area is at the heart, right, of their city, and they're gonna have to do something to change it into more of a mixed-use environment.
Yeah, I think from a market perspective, if you can convert something in downtown Dallas, the residents will come. I mean, like the gentleman before said, we have been the recipient of lots of migration into Texas, right? And specifically into Dallas, Goldman Sachs, Morgan Stanley. These are huge companies, JP Morgan. These are big financial centers now, and that has changed the makeup of Dallas. So it is starting to make more sense. The city is very pro-business. We can get incentives to make those conversions happen where they make sense. What I don't know in your 12% is, when I think of conversion, I think taking an office building, turning it into residential. We have some huge buildings in downtown Dallas. I think you could take half of it and convert it, which may not do the whole 1 million square feet, and that may still work if you've got enough incentive. But we also have areas around downtown that are still considered Dallas in that area that have been warehouses and have been converted to high-rise multifamily in the design district, in Deep Ellum, in areas just surrounding the proper downtown. There's not a lot of conversion in Uptown, although there is some displacement of older buildings turning into office buildings, or like what we did, turn 110,000 feet of office buildings into 600. So I don't know how all that works into statistics, because I'm not the researcher, but I think the pro-business aspect, the fact that the market can support it, and we have lots of new residences or residential people coming in that want to be down there and close to their employer. Our commute's different. These guys deal with trains and buses and everything else. We deal with a tollway that costs a worker. You take a worker making $70,000 a year, and they got to spend $20 a day commuting on a toll. They want to work from home, right? And so that's a real issue for our city. It's not the low-cost environment that it used to be either.
Right there.
Yeah, I don't, you might have touched on it, I apologize if I did. Are you seeing any, you mentioned, property values are gonna have to reset. Are you seeing some trades in that area where people are beginning, and is it, I suppose it's privately driven maybe, by private money or entrepreneurs that can see the use for these buildings?
When you say trades, we are just at the beginning, I think, of trades that are occurring from an office perspective.
Yeah.
Both the trophy assets that have been owned for a while by some folks that feel like it's close enough for them to trade, and then older buildings that just aren't worth what they were once worth. And so you're starting to see a reset on some buildings, but I think we're still in the first couple innings of that.
So when you say, the trophy buyers are seeing, you said they're seeing it where it might work, is those prices have dropped to a level that they find attractive, or?
Well, to give you an example, there's, assets that are around the 2000 vintage or 2010 vintage that have been owned for 7-10 years by someone. They're very well occupied. They've kind of reset lease rates to, the current cost and the current cost structures, and so those owners are looking to get out. They're able to sell those buildings for, call it, $500 a square foot, which is still 60% to replacement cost today. So they can get out almost, maybe not whole from what they paid or very close to it, but they can sell it into a market that will pay that because it's 60% of replacement cost, and they feel like they got some upside to the new buyer. So you're starting to see those trades, but those are recent. Those are just starting to happen. The taxing authorities are working with owners to lower taxes. We've actually, first time we've ever had to go to litigation on taxes. We've always fought them and usually negotiate something harder in a rising tide market versus what we have today. And we never had to go to litigation. The city came back and said, okay, we accept your number. So you're seeing some of that reset, and it just takes time, right? I mean, if you think the previous panel talked about the retail industry. In 2010, they were in the dumps. It's taken 15 years for them to be the darling of investment community today. I don't think office will take 15 years, but we're 7 years into, what happened in 2020 to our office market. And so I think it's gonna take another 3 or 4 years before we really get a sense of where the dust is settled.
Ethan?
Yeah, I was just curious, I've noticed, a lot of, I think, and the vacancy starting to come down. It does seem like a lot of companies are not shrinking as much when they sign deals, especially in New York. It feels like a lot of companies are expanding when they're signing leases these days. I'm curious, how much of that is driven by they're hiring more, they're growing? How much is driven by, maybe anticipating a tighter market? And how much is driven by maybe, because right before the pandemic, when a lot of these deals were signed, they're rolling over, like in 2016, 2017, 2018, open office plans, all these benching. And how much of this growth is driven by just the per square foot per employee is growing? Because when people come back to the office, they can't work like this, anymore. They need space, they need quiet.
So I think it depends on industry. So we talked a lot about financial services, and what's interesting about financial services is that their share of leasing, which leasing is almost back to where it was pre-pandemic as of last quarter, but their share of leasing is about the same as it has been, which is strong, right? And they've switched places with tech, because if you look back in 2018-19, it was technology firms that were driving the largest share of leasing. Now tech firms have catapulted back a lot of because of what Danny was talking with AI in San Francisco that's having a trickle-down effect. But finance has been the strong one. What is the other difference with finance, and I grew up in the finance world where I was doing a lot of the seating arrangements, is that it was always about efficiency after the financial crisis. How many people can we fit in space to make it as efficient as possible? Well, now financial services clients or the tenants are the ones that want their employees back more, right? They're the ones that are pushing that envelope on getting employees back, so they have to give them a better employee experience. So I don't think it's coincidence that their leasing is increasing during a time when they're also now focused more on employee experience, which means that they're needing some more space. So I think that is definitely a piece of it. I will also say, I agree that we are past peak contraction, right? And if you look at the average size of the lease, it is still way smaller than it was, but it's now back on the increasing swing, so that's a good thing. However, I just lost my train of thought there for a second. But it is on the increasing swing. And I know what it is, but the larger companies, so when you're looking at the really well-heeled companies that are going into like a lot of this prime space, they actually signal that they're still contracting. And the reason that they're still contracting is no different than it was before the pandemic, which is that they are still trying to create pre-pandemic inefficiencies. Because although the average lease is 7 years, the average lease for a really large requirement is like 15 years, right? So it's taking them longer to cycle out of this, so they're still the ones, whereas the smaller companies, under 500 employees, they're all about growth right now because they're signaling that they are growing from a business standpoint.
It's been interesting, I'm sorry, go ahead. It's so nuanced. Every customer that we have is making a different decision for different reasons. They have certain employees that sit behind a computer all day long. They don't have to be in the office as much, so they are bifurcating how they're using their space. They're trying to provide space for people to come back to, so their average square foot per person of people using the space seems to be going up for most companies. Law firms, they don't need law libraries, they don't need a lot of that space, so they actually are taking 70% of the space they had, and they can pay more to be in the best space. So they are contracting, yet they are paying the highest rate ever that they've paid for their office space. So it's very nuanced depending on who you're talking to.
Yeah, I just wanted to answer that real quick. So I think the sweet spot of this expansion is really the mid-sized tenants. And you know, let's call it anywhere between 10 to 50,000 square feet. It's really where you're seeing some of that more expansion happening. But to Greg and Julie's point here, you know, those larger occupiers, it's nothing new. They've been contracting before the pandemic, right? The whole flight to quality, flight to efficiency, it's been happening and it's continued to happen at that larger size.
All right, that's all we have time for. Thank you guys for joining this panel. This is really interesting, and thank you all for listening.